About to leave, already packing. Come with me, I'm not really asking. We'll get away to a place where we don't know. About to see the world in action, what we can be, life with no distractions. We'll get away, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out. Die with my own doubts. Be free with me. Let's be free with me. Not looking back, eyes on the freeway, Bonnie and Clyde, a classic cliche. We're on the run, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out. Die with my own doubts. Be free.
Evening everyone, it's Jim here at TutorDuo. Welcome to the second in our series of live revision sessions supporting students getting ready for the BTEC National Unit 3 exam in January 2022 is the next sitting. If you're watching live, welcome. We've got about 25 minutes or so, might be a few minutes more, on measuring liquidity. Yesterday we did the session, or our first session, we did on measuring profitability. And liquidity is another important part of the business finance part of the Unit 3 specification. So we're going to go through 3 or 4 activities that will introduce you and test you on the key terms and concepts. Also, we've got some calculations, so you might want to grab your smartphone or calculator just to give yourself a hand with some, not too many, but a few calculations. And then we'll wrap up with a little higher or lower activity. And if you're watching on replay or catch up, of course, we won't get to see your answers in the live chat, but hopefully you get a chance to give yourself a bit more time by pausing the video. Give yourself plenty of time, see if you can work out the answers before starting the video again and seeing if your answers compare with ours. Are we good to go? Let's make a start then. And our first activity is a 60-second challenge with a festive twist. We've got 6 terms on the left hand side there, A, B, C, D, E and F, and on the right hand side of the festive fireplace we have 6 either definitions or formulae, and what you need to do is to match the letter with the number. So for example, if you thought that current assets are calculated as current assets divided by current liabilities, you would type A5 or write A5 down. I don't think that's right. I might be wrong. But anyway, I'm going to give you 60 seconds to try and match as many of those letters and numbers as you can. So have a go and then we'll go through the answers once we've been through the minute. Here we go.
Hold up, I am on my way. I'm in motion. Let's go to the ocean. Yeah, let's go outside. We can hang out on the beach without freezing. Yeah, isn't that amazing? In Christmas times, we'll be chilling and having a good time. Doesn't matter if the snow is falling or the wind blows and the rain is pouring. It will always be Christmas in my heart. But this year I wanna hang out with my friends and family, making angels in the sand. You ready? Doesn't matter, it is Christmas in my heart. And I can...
And as the cuckoo clock signals 60 seconds up, how do we get on? Compare your matching of letters and numbers with the correct answers, and here they are on screen. Current assets is the first one, and what we've done there is map that with number 4. A4 was the answer. Current assets, these include things like inventories, trade receivables, that's the amounts that we are owed by our customers, and prepayments. And don't forget also, current assets also include cash in the bank and also cash that you've got in hand. Current liabilities is the other side of the coin, isn't it? It's amounts that we owe. And in particular, we owe and we'll have to pay within the next 12 months. So a bank overdraft, or an overdraft, is a liability. The bank could ask for that to be repaid at any stage. Trade payables, that's amounts that we owe to our suppliers. And also accruals. Now, don't forget, we're going to be doing a session on prepayments and accruals in early January, because that's quite a complicated part of the specification. But those are both mentioned in current assets and current liabilities. Current ratio is a ratio that we calculate, and the formula is current assets divided by current liabilities. Really important that you know your formulae. And for liquidity, there are 2 ratios to learn. One is the current ratio, and the other one is D, the liquid capital ratio, which is quite similar to the current ratio. But what we do is we make one small or significant adjustment. We take away the value of inventories from the total for current assets before we calculate the ratio. And we'll have a look at the liquid capital ratio in the next 15-20 minutes or so. Liquidity, well, that's the topic of this session, isn't it? And liquidity is all about, does the business have enough cash to be able to pay what it owes? Does it have assets like cash, inventories, trade receivables that it can turn into money that enables it to pay the liabilities, the current liability? Trade receivables, we mentioned at the top there, that is one of the current assets. Trade receivables are where we allow our customers to buy things on credit. They owe us money, therefore that is an amount that is receivable by the business. Hopefully you got all 6 of those right, but it's a good introduction to some key terms that we're going to cover in this session. And it's really important throughout Unit 3 that you try to become as familiar as possible with all the different financial terms. We do understand that they all sound very similar sounding names like current assets and current ratio and current liabilities, but they all have a specific meaning. So it's not just about doing calculations, it's also about understanding what they are. That will really help you answer questions well. Okay, let's move on to another little sort of quiz activity, again with a festive twist. This is the Bauble quiz. If you've done our previous sessions in other subjects or for BTEC, you'll know the bubble quiz. The idea here is we set a question and there are 4 suggested answers, some of which could be right, none of which could be right, or all of which could be right. So have a go. Yes, Shreya, this session is very useful for A-level business, Edexcel business as well. But this session is specifically designed for BTEC National students getting ready for their business finance exam, Unit 3. But hang around, have a go at this question. Which of these, of the 4 listed there, are included in the formula for calculating the liquid capital ratio? We mentioned this just a few minutes ago. The four options for you are A, current assets, B, inventories, C, current liabilities, and D, depreciation. So have a think. Three of those are mentioned in the formula for liquid capital ratio. Going to give you a few more seconds, particularly if you're on catch up. Of course, if you're on catch up and replay, you can just press that pause on the video. That's a great way of giving yourself as long as you want. You could have a whole day on this question if you wish, but we don't need that with our live audience because we've already got a correct answer in the live chat, and it is indeed A, B, and C. The formula is current assets less inventories divided by current liabilities. Depreciation, whilst interesting, has nothing at all to do with liquidity. Question 2. Which of these would suggest an improvement in the liquidity of a business? And it looks like they're all to do with ratios. So would it be a lower current ratio? Would it be a higher liquid capital ratio? Would it be a lower liquid capital ratio? And or would it be a higher current ratio? Well, looking at those answers, I don't think it's going to be all four, but which of those would improve or suggest an improved liquidity position? It's got to be at least some of them, hasn't it? But which ones? What do we think? Got some answers coming through. Some of the answers in our live audience are suggesting D, higher current ratio. Any more than D? A few more seconds. Let's take a look, and the answer is, it is indeed D, but also B. Don't forget, liquid capital ratio and current ratio are both measures of liquidity, and they both tell us something about the liquidity of a business, and if they both rise, that's generally good news. That suggests that the business has improved liquidity. Now, question 3. Which of these are included in current assets? Don't forget, with liquidity, you really need to have an understanding of the different items in the statement of financial position, otherwise known as the balance sheet. Which of those, A, B, C, and or D, are in current assets? I'll give you a clue. It's definitely one of them, and probably more. Trade receivables is A, inventories is B, cash balances is C, and current liabilities is D. Current assets. We know that current assets is part of that formula for the current ratio, don't we? Current assets divided by current liabilities. That might rule one of them out. Let's have a look at the answer. The answer is indeed A, B, and C. Current assets is a total of different items. Trade receivables, the amounts that are owed to us by our customers. Inventories, the stocks, the raw materials, the finished goods that we have in the business that we've not yet sold or turned into products. And of course, good old cash. See, really important to have some cash in the business. Current liabilities is the bottom part of the ratio. So that's not a current asset. Excellent stuff. Now we're going to do 3 short calculations here, and I say short, they don't involve too many parts. So because of that, I am going to cut down the amount of time that I give you on screen for the live audience, of course, to 30 seconds. We've got 3 of these coming up. Obviously, if you're watching on replay and catch up, you can take as long as you like, but try to do it within the time if you can. Here's the first one. The following information, or the information over there in the table, relates to last year, and it's been provided by a business, and we want to calculate the current ratio for last year based on that information on the table. So, calculators, smartphones, other calculating implements at the ready. Here's your 30 seconds. What do we think? Now, don't forget, we're going to go through a stepped process for helping you pick up the marks in the calculations in Unit 3, particularly with the financial calculations. They can be a bit daunting at times, but there are ways in which you can give yourself a better chance of getting all the marks on offer. Let's take a look at the answer. In this case, it's 3.09. Well, there is a three-step approach to answering all of these questions, and I highly recommend that you practice using this and also use it in the Unit 3 exam. The first step is to write down the formula. So we know that the current ratio, it's current assets divided by current liabilities. So we do the maths. The current assets are 260,000 from the top there, and current liabilities 84,000. So we just divide one by the other. Now don't forget, a ratio is a number. It's not a percentage. It's not in units, so it's a number. I would typically write it down to 2 decimal places unless you're told otherwise. So 3.09 was the result of dividing 260,000 by £84,000. So you get the idea. Shall we have a go at another one? But this one is a different ratio and a different business. So the owner of this business wants to measure her liquidity position and has given you some information in the table there. But she wants you to calculate the liquid capital ratio. So if you think back 5 or 6 minutes earlier when we explained what you do to get to the liquid capital ratio, that will hopefully help you write the formula down, put the numbers in, and let me know what the answer is in 30 seconds. Here we go. Soon goes, doesn't it? Soon goes past 30 seconds. So don't forget, it's a 3-step process. First thing we do is we write the formula down. We know that the liquid capital ratio, it's similar to the current ratio, but we need to make an adjustment. We take current assets and we take away inventory. And the reason why we do that is because it's harder for a business to turn inventory into cash. It takes a little while longer. So it's, if you like, a better test, a more realistic test of liquidity. So 45,000 take away 8,000, and we divide that by current liabilities, and the answer is 1.37. Okay, last one here. This time I'm not going to give you a table of information. I'm just going to give you some numbers contained within some text. So at the end of last month, a business had inventory of £16,724. Cash balances of 36,870 and trade payables of 14,350. Now, just using that information, can you calculate the current ratio? The current ratio. Here we go. So on this one, we have to remember that the current assets, it includes some different items, doesn't it? And we mentioned some of them earlier. In this case, we're going to be using the inventory and the cash balances. They are both current assets. And underneath the bottom part of the current ratio, that's current liabilities. That includes trade payables. So that's going to be in the bottom part of our calculation. So the formula, our current assets is 16,724. That's the inventories, plus the cash balances, 36,870. That business has got lots of cash, hasn't it? And a fair bit of inventory too. On the bottom part, it's the trade payables. That's the current liabilities, 14,350. If we work those numbers out, that's 53,594 to be precise, of current assets. And we divide by our current liabilities, 14,350. 3.73, which is a very healthy current ratio. That suggests that that business doesn't have any liquidity issues, does it? Because it's got cash of almost £37,000. It's well able to pay what it owes to its suppliers, 14,350. So it does not have, at first sight, any major liquidity problems. That business is looking good. Excellent. So I've just mentioned this approach to calculating numbers in Unit 3. It is well worth your while doing this, not the least because you can get marks, particularly, as has been mentioned in the live chat, if you know the formula. So that's the first step. Write down the formula. If you're asked to calculate something, let's say it's the current ratio, or as we were dealing in profitability, if we were calculating the gross profit margin, or perhaps if we were doing break even, the break even output. Write the formula down, you'll get a mark for the formula. What you then do is you use all the data provided to you and just substitute the data into your formula. There'll be something missing, one piece, so that's the answer. So the answer is what's missing. And don't forget in step 3 to use appropriate units. Where we're talking ratios for liquidity, it's not a percentage, it's just a number. Hopefully that's useful. Well worth remembering that and practicing that before the Unit 3 exam. Before we finish with our last final activity, let's just do a quick festive MCQ. I thought I'd turn a multiple choice question into a bit of a Christmas present or festive present quiz, but these questions are all on liquidity. So all you need to do is to look at the question and decide which of A, B, C or D is the correct answer. With MCQs, only one of the answers is correct for the question. Here's question 1. What is removed from current assets in order to calculate the liquid capital ratio? What do we think? Just have a feeling. I might need to watch the replay that we've mentioned this a couple of times already. Is it receivables? Do we take away prepayments? Do we take away inventories? Or do we take away cash balances? Most of the answers coming through in the live chat are spot on. As always, it has to be said. Let's take a look. And the answer is C, inventories. That's the only difference between the current ratio and the liquid capital ratio. The current ratio is just current assets divided by current liabilities. For the liquid capital, just remember, take away the inventories. Get rid of the inventories because they are harder to sell, harder to turn into cash. Okay, that's excellent. Question 2. Which of these is likely to result in a business having a lower liquid capital ratio? What do we think? This is quite a hard question. Is it A, lower non-current liabilities? Is it B, higher depreciation? Is it C, lower inventory turnover? Or D, higher profits? Give yourself a few seconds to think about this one. What might result in a business having a lower, i.e. a worse, liquid capital ratio, a lower ratio? That would suggest worse liquidity. Not such an easy one, that one. Got some answers coming in. Let's have a look at the answer. It is C. Yeah, lower inventory turnover. That would suggest, and we're going to look at this in our next session, next Wednesday, when we look at efficiency ratios. Things like inventory turnover, payables days, receivables days. Lower inventory turnover suggests that we have higher values of inventory. We've got more inventory sat in the business that we can't sell or turn into products. It means that lower inventory turnover means we are less efficient. Now, if we've got higher inventory, therefore, because of lower inventory turnover, when we take that away from current assets, that is likely to mean our liquid capital ratio is going to fall. So we've got too much cash tied up in inventories. Higher profits would probably result in a higher liquid capital ratio because it suggests that we'd be making higher profits. We should have more cash, shouldn't we? Or more receivables. Anyway, the answer is C. And we've got one more. Another question. A business wants to increase its current ratio. Why wouldn't you? Which of these is most likely to achieve this? So which of these 4 is most likely to increase the current ratio? Is it A, offering suppliers more trade credit? Is it B, selling non-current assets for cash? Is it C, increasing the amount of inventories held? Or is it D, reducing trade receivables days? What do we think? This is a hard question, but it goes right to the heart of understanding the current ratio and what businesses can do to try to improve their liquidity position. We've already got a correct answer in the live chat window, but I'm just going to give everybody else a few more seconds. Obviously, people watching on replay don't see the live chat window. They'll have to work it out for themselves. Minecraft, you are correct. It is B. I know what you're thinking. It could be C, but I'll explain why it isn't C. Here's the answer. It is B. Well done. Well, firstly, if we offer suppliers more trade credit, that was answer A, that would increase trade payables. That would increase the bottom bit, current liabilities, wouldn't it? That's not going to help our current ratio. That's going to lower the current ratio. I'll come back to B. Increasing the amount of inventories held. Well, that would only happen if we either paid cash for that, in which case inventories go up and cash goes down, or if we get an equivalent amount of trade credit. Those inventories go up, but the suppliers say, we'll pay us later. But however you do that, the current ratio will not increase. And reducing trade receivables days will just swap trade receivables for cash. So there's no effect on current assets. However, the one thing that will definitely increase the current ratio is if we can sell some non-current assets for cash, cash will increase, therefore current assets will go up, but our non-current assets will fall. Well, non-current assets aren't involved in the current ratio, are they? So that would be good news for the current ratio. That would improve the liquidity position. Can you see what I mean? All the others don't really help the current ratio, but B definitely does, because cash goes up. Therefore, the top part of the ratio will increase. Hopefully that makes sense. That is not an easy question, though. So you might need to spend a little bit of time just thinking it through. But it is a good way of improving liquidity. Sell any spare non-current assets. If you've got some cars lying around or some factory equipment or a bit of spare land, get them sold, get the cash into the business. All of a sudden, life becomes a lot easier when you're running the business. Okay, right, we're going to finish. Perfect timing. We've got 3 minutes left before the end of the session. Let's have a game of higher or lower. Now, yesterday, or in session 1, we had a game of higher or lower with the gross profit margin of some well-known businesses. And what I've done is I've gone back to the accounts of some other well-known businesses and found out what their current ratio is. How interesting. Well, if you're like me, you find it interesting. So Apple, let me give you the first one. Apple has a current ratio, that's current assets divided by current liabilities, of 1.07. Interesting. What is the current ratio of McDonald's? Is it higher or lower than Apple? What do we think? Give yourself a few seconds to think. McDonald's, will it have a current ratio higher or lower than Apple? I think I agree with the first answer in the live chat window. From a familiar name in the live chat, I think I agree with it, but what does everybody else think? What do you think if you're watching on replay? Higher or lower? Should we take a look? It is indeed higher, 1.33, which, if you can imagine how much cash and inventories is held by McDonald's, suggests that the current assets are very high. But obviously, they owe lots of money to suppliers, to their burger suppliers, their bun suppliers, their chicken nugget suppliers. But 1.33, a higher current ratio than Apple. Let's take a look at the next one. Amazon, what do we think? Amazon, higher or lower than McDonald's? What do we think? Give you 10 seconds to have a muse on Amazon. Obviously, Amazon's got a lot of inventories, hasn't it? Lots and lots of stock sat in the warehouses, but we're talking about the current ratio here, not the liquid capital ratio. Also, interestingly, with Amazon, quite a lot of the inventory which they hold is not actually owned by Amazon. It only becomes theirs, or they only have to pay for it when it's sold. It's sat there, sent in by suppliers in the hope that someone will buy it. Okay, let's have a look. The answer is, it is lower. It is lower. It's nearer to Apple, isn't it? 1.12. 1.12. Well done if you went for lower. And our last one, Tesco. What do we think? Tesco, is it higher or lower than Amazon's current ratio of 1.12? This one might surprise you, but I'll give you a few seconds to think it through first. Okay. Well, it looks like the live chat window, the live audience tonight are going lower, and it is indeed lower. Now, look at this, 0.76 according to Tesco's latest accounts. I'm pretty sure that was the third quarter 2021 latest statement of financial position. Now, is that bad news? 0.76. That would suggest, wouldn't it, that current assets are lower than current liabilities. Would that suggest a liquidity problem for Tesco's? Well, the answer is no, it doesn't, because the current ratio of a business will always depend on how the business operates. So Tesco's does owe a lot of money to its suppliers and a lot of current liabilities. However, it's constantly turning sales into cash. It's always able to pay its suppliers. So it doesn't actually need lots and lots of current assets and inventories to be able to pay its suppliers. It can run fairly lean. It actually turns over its inventories. It has a very high inventory turnover. Imagine how many people are taking trolleys out of the supermarket each day, how many times Tesco's delivering inventories to people at home. Very high inventory turnover, and therefore it's not a problem. It can generate cash very quickly. Therefore it can run a quite low current ratio. I thought that was interesting, isn't it? Some interesting data there on the current ratios. There we go. That's half an hour or 30 minutes. Let's go to the right scene, shall we? It's just me tonight. That was me imagining I got two people presenting with me. Hopefully that's useful. That's been 30 minutes where we've been taking a look at liquidity ratios. Now, next up, we are looking at measuring efficiency. That'll be next Wednesday at 4:30, I think. 4:30 for BTEC Unit 3. We've got one more Unit 3 session before the festive break. And also next Monday, we've got our third Unit 2 session where we actually work our way through a complete worked answer to one of the sample papers. So if that's you, if you're taking Unit 2 and or Unit 3 in January, hopefully you'll join me again for another live session. If you've been watching and catch up and replay, fantastic. Many thanks for that. Always ask this. I never take it for granted. If you found the session useful, give it a like, give it a thumbs up on YouTube. That helps. That makes me happy, but it also helps the YouTube algorithm suggest this content to other students who might find these sessions useful. But for now, hopefully you've enjoyed the session. I'll catch you on the next one. Cheers.